statutory pension plan, pension committee meeting. We do have a quorum. We have Fred Combs, Nikki Falkenberry, Brian Brewster, Ed Atkins, and Daryl Sebastian. And if everyone's had a chance to read the minutes, if there are no changes, I'll take a motion to approve the minutes, please.
I'll make the motion to approve the minutes.
Okay, I need a second, please.
Second.
Okay. Okay. Pam from Mariner is stuck in traffic right now. We'll wait a few minutes on her, so we'll move on to old business. We're doing a contract extension. The pension evaluation committee was a tie. So in order to move on right now, Jill decided to go ahead and do an extension with Mariner until June 30th, 2021, and we will reissue the RFP in the spring. So we will keep you all posted on that. And then our item of new business, I think Brian, you mentioned you wanted to check on the time of the next meeting.
We can adjust some type of uniform time when, as of right now, we know when everybody will be more available.
Okay. The meeting schedule that was approved by the board in July has the date set, but this committee can change the date of the next meeting. Stephanie, do you have the date of the next meeting? Is it February 9th?
Yes, and then May 11th.
Okay, February 9th and May 11th are the next two meetings. Those are Tuesdays at 10 a.m. Do you have any suggestions, Brian, of when you'd like to change it? We do have to publish it because it was published with the board meeting schedule.
I don't know, is there a uniform day that all of us,
Well,
I mean, I realize the run pit's coming up,
yeah,
that kind of,
if we could, I'd rather wait until after this run.
Run pick, okay.
You know, we're doing the run pick quite early
Okay.
in December, but it doesn't go into effect, of course, until December the 20th.
Okay.
So sometime between maybe when we do the run pick and before it's enforced, could we?
Okay. Well, around the first of the year then, I'll make a note that we'll send out something that about the February 9th meeting and see if we need to change it.
so
See
even
what-
anything a month from now, because I know Ed might pick the first day, I don't know if are you the first day or second day for run picks?
Second.
Okay, so I mean, sometime on Tuesday, you know, the second day run picks is, we would know.
Okay. Well, I'll make a note for around the 1st of January then to send out a notice and see what would be the best time for you all to meet. So right now it's tentatively scheduled for February 9th at 10 a.m. And so I'll get with you all and see. Okay, does anyone else have any old business or new business?
I was wondering if we could, a few days after the meeting, if we could get a copy of the minutes so that I could look at them while it's still fresh in my mind.
Okay.
Just put a copy in my mailbox or something.
How about we say within 2 weeks of the meeting date, we'll have those out. Will that work? Okay. we'll give Pam a few minutes.
I think she's trying to hear you.
You need to go through the, would you care to take her to the health check? Thank you. Steve, you have anything to add while we're waiting?
No, I really don't. We'll be working on the annual actual report starting in January or so.
Seems like we just did that, doesn't it?
We did just do that.
Thank you, Darryl.
I'm sure you'll be glad to see 2020 come to an end.
Oh, yeah, we all will.
Yes.
Thank you, sorry about that.
Sorry. Are you ready for me?
Yes, we're ready for you. We've gone through the minutes and we're ready.
Yeah, I don't know if that's construction or accident on the highway, right where 75 and 64 came together, comes to a screeching halt. And I thought an accident, but then it was saying construction. So
Oh, goodness.
So I apologize for being a few minutes late. All right, so I am Pam Thompson with Mariner Wealth Advisors. And we're very happy to be here reviewing the pension plan. We always like to start with just a kind of a brief update on what's going on with our firm, and then your investment policy before jumping into the details. The first page is just at a very high level. We are continuing for the most part to operate virtually as much as possible. We're able to do a lot of things from different locations as we watch the whole COVID situation. But we do maintain our Kentucky office out of Louisville, and so I'm coming from there today. But as we go into the next couple of pages, really it's important each time when we're reviewing the investments to remember the context that we are managing that in. So we customize this investment portfolio for your pension plan. So it's very important that we understand the objectives and that we're all on the same page. And we've had, a few times over the years that there's been an interest in discussing certain points and even making a change from time to time. So at the top of page 3, the very most important part of this is the asset allocation. That's just what percentage of the investments are in stocks versus bonds. That will determine the growth long term, as well as the volatility that you see in short-term periods of time. So as you can see, the range for stocks is from 50 to 80%, with a kind of median target of about 60, with the remainder being in fixed income. That 60 to 80% equity is what will give growth over time that is very necessary for a plan such as this that really needs to last forever and be able to pay people throughout their retirement. The rest of the restrictions that are just highlighted here, restrictions and tolerance, et cetera, is just to make sure that it's very well diversified, it's always very high quality, and just very prudent standards that we are using at your request in terms of choosing the individual investments. So this is just the summary on page 3. The full document goes through the next several pages, and this has not changed in several years, but I'll just pause for a moment if there's any interest in discussing any specifics. Are there any questions that anyone has? Okay, so we can move on then. So turning past the first tab to page 15. Here, just starting with a high-level overview of what we've seen in the market. 2019 is starting to feel like ancient history after the year that we've had, but it's important context to remember that the market has strong years and it has weak years. So on page 15, we're looking at 2019, which was actually a very, very strong year in the market, with U.S. stocks, international stocks, large cap, small cap, everything was up very strongly across the board. Those different colored lines correspond to the different indices across the top. If you turn to page 16, you'll see kind of what we've been going through so far this year, where we had the reaction to the coronavirus and the shutdown of the economy really hit the market very hard back in February and March, as you know. It's been a very sharp recovery since then. It came back more quickly than a lot of people would thought. Through the end of October, it had actually trailed off a little bit. If anybody's watching here recently, we've actually seen a very significant surge since then. But basically through the end of October, we were still seeing, a good number of stocks still down. The average stock was probably still down about 10% when you look at the different indices here. Turning to page 17, just a little bit more commentary on just market versus economy. It can surprise people a lot when you see the market really moving strongly and coming back even when there's still so much uncertainty about the economy. And that's what we were seeing a lot of through the summer and into the early fall. What this page is showing us on 17 is just the relationship between different economic recessions that we have had and the stock market. So what you're seeing here is every economic recession back to 1929, showing when did it start, when did it end, and how long did it last and the number of months, but then comparing that to when did the stock market bottom for each of those particular cycles, and how far ahead of the economy did we see that happen. And you can see there's a whole different range of time frames there, but very consistently what you see is that the market is moving before the economy, and that's a very normal thing. The market is always looking out into the future. Sometimes many, many months. The average has been about 4 months in these different economic recessions. And so even though there's a different reason every time, and there are, of course, still things to work out, it's a very normal relationship to see the stock market plowing full steam ahead, even when the economy might not be all the way there. So it's just, I think, an important reminder during times like this that relationship is very normal. Sometimes the market can be ahead of itself and need to pull back, but it is normal that it is moving ahead of the economy. And then just one more commentary page on page 18, where we refer to this as the dangers of trying to time the market. What we are looking at here is a hypothetical investment scenario. If you would have invested just in the S&P 500 on January 1st of 1995, and held that investment through June 30th of this year, so that includes the big drop with COVID. So basically a 25-year period of time. The far left-hand bar is showing that if you remain fully invested 100% in that for 25 years, your average return would have been 7.8% per year, your total return. If over that 25-year period of time, you only miss the 5 best single days in the market, 5 days only out of 25 years, your total return over that 25 years would drop from 7.8% to an average of 5.9% per year. That's a significant drop for a 25-year period of time based on just 5 days. And as you go further to the right, the more days you miss, the better days you miss, the lower and lower the returns get. The point here is twofold. One, how dangerous it is to miss even just the few of the very best days in the market, but also to realize that those best days very oftentimes come immediately after some of the very worst days in the market. And so the very worst thing to do is when it feels scary and things are falling in the market to say, oh gosh, we better get out and wait till it feels better, because that is exactly how this kind of thing happens. So we don't want to do that. We don't do that. And I think it's an important reminder as things can get emotional when people see how much the market is moving around. And I say that's also why it is so important that we're always reviewing the balance in the portfolio to make sure that is appropriate and everybody understands and feels comfortable with that overall balance, so that we're not ever in a situation of wanting to pull back in stocks at a time that they're down. So let's move on to the specifics of the portfolio on page 19. This is a snapshot of the pension plan as of the end of October. So this was done on October 31st of 2020. The pie chart is showing us that overall asset allocation. We, at end of October, had a total equity allocation of 69%. So right in there between your 50 and 80% range. Of that 69% in the pie chart, you can see the largest part of that is U.S. large cap at 55%, about 4% small and mid cap, and about 10% international. So that all together makes up the 69%. The other 31% is the fixed income, very stable portion of the portfolio. This is the part that does not grow. It holds its value. It creates a cushion during times of volatility. And that balance is very, very important. If you look in the upper right-hand corner, we'll review the returns. So we have 4 columns here. The most recent year so far through the end of October. So for the 10 months through October, with the decline that we saw and the recovery from that, we're back into positive territory, positive 1.4% for that 10-month period. And you see the breakdown, the fixed income and the equity components are the subcomponents within that total. For just the third quarter, since we're reviewing this quarterly, we've had very volatile quarters where we had the drop that occurred in March, and then we've seen things recover. But just the third quarter was actually up 6.3%, so it was continuing that recovery from what we had seen. A reminder that last year was very, very strong. The total portfolio return was 21.2%. And then the historical return, the long-term average since inception, has averaged 6.5% per year. So that is what we would say is, right in line with what we would expect, what we would say is a good target. I believe the actuarial, and Steve, maybe you can correct me, are you at 6% actuarial or are you at 6.5%?
6.5.
It is 6.5. Okay, so we're right there. And so just, remembering too with the volatility, we're going to have different periods of time. I think if anybody's been watching the market, we've had a tremendous surge here recently, so I thought you guys might be curious where we are. So I did take a look just this morning through yesterday, just through November 9th, just for the month so far. The portfolio is up another 6.7% just since the end of October. And so the full year to date through yesterday was at 8.4% for the total portfolio. So we've seen a very nice continuance of that recovery. Are there any questions on this at the high level overall?
Pam, may I ask a question?
Yeah.
What did you say the year-to-date return was through September? Was that 6.3?
Actually, the third quarter, just the third quarter was 6.3.
Was 6.3, okay, thanks.
The year-to-date number that I have is through October. We actually saw the market drop again in October. The year-to-date through October was 1.4. But then the difference between year-to-date October 1.4 and yesterday is up to 8.4. So. so then the next few pages get into some of the details. So that's at the high level on the allocation. Moving then to page 20, so we are using a combination of individual stocks and passive ETF funds. So it's a blend of the passive and the active. So on page 20 is highlighting the active part of the portfolio. So this is within the U.S. large cap. We have approximately 40 individual stocks, give or take. Here we're breaking them into three basic categories. From left to right, you'll see the group on the left we call growth and income. These are stocks that have either a higher than average dividend yield or a very steadily above average dividend yield growth rate, so growth of the income, and generally a lower beta, which means lower volatility. So this group on the left we would consider within the stocks kind of the stable core of higher income, growing income, and less volatility. As we move to the right, in the center, this group we call cyclical growth. These will generally be a little bit more sensitive to the economic cycle. They are frequently stocks that we will purchase opportunistically. They can see a little bit more fluctuation up and down just based on the nature of being more cyclical. And then the group on the right we call high growth. These are companies that are consistently growing at an above average pace, meaning just the earnings of the company are growing. So we would expect that for the stock price over time. And they tend to be less sensitive to the economic cycle. So slightly different set of variables. That's usually just because of the industry that they're in or their particular business model that makes them more steadily high growth. So the focus on this page is as we kind of look at the balance between these three categories, you're seeing a very nice balance. You know, they bring different things to the portfolio at different points in time, and that's another element of the diversification that we have within the portfolio. Turning to the next page, you know, hand in hand with having individual stocks on page 21, it's very important with individual stocks to not have too much emphasis in any one company. We want to maintain a very good diversification within those individual stocks. So here, we're simply listing the 10, which as of October 31st happen to be the largest positions in the portfolio, ranked highest to lowest. And the percent on the far right is just showing you what percent each of these stocks makes up as a percent of the total stocks. So you see right now the largest is at 3.8%. That's FedEx. That stock has done very, very well with all the shipping of things that are being done. You can see how much that's grown from where we purchased it, the cost to the market value. But as you look at that far right-hand column, you'll see that everything is, you know, well within our threshold, and on your investment policy is a 5% maximum, so we're well within that. The top 10 together make up about 31% of the stock, so it's just a very nice balance and diversification. You can also see under the sector column that they represent many different parts of the economy, many different economic sectors as well. So that's just another indication of it being diversified. Turning to page 22, here we have a listing of the passive part of the portfolio. So with the individual stocks, that's the active. Here we are using some ETFs, which is the passive portion. Within large cap, we're using both the Russell 1000 Growth Index and the Russell 1000 Value. Then for small cap and international, we are using basically the full market, the Russell 2000 and the EFA. So as you can see, and as we saw in the earlier chart, international and small cap have simply not done as well in this environment. So those have been negative returns, but that is just what that part of the market is doing. Interestingly, you can see the difference between growth and value. So you might hear talk about that in the news if you're watching. Yeah.
So passive means mutual funds and index funds?
Passive would be pretty much index funds. There are mutual funds that are actively managed. So just being a fund does not necessarily mean passive, but that's what this is here. So the ones that we are using are all index. They track a specific index.
And active means pick an individual stock?
Right. So you can purchase a mutual fund that has a manager that's, you know, picking those individual stocks, just like we are doing with your individual stocks. But since we're doing that with your stocks, this is just to get representation in certain parts of the market.
Pam, I have a question that probably should have been asked a couple, 3 pages back, but I've been kind of watching the market this week. And
Yeah.
day before yesterday, I think it went over 30,000 on the news that the COVID vaccine has a pretty good
Right.
chance of working. Do you expect this market to have a hard crash soon?
What we would say is, I'm going to take a step back a little bit and say that on average, every year, so on average about every 12 months, we tend to get a full correction in the market, which is a drop.
That would have been a better term for me.
Yeah, a drop of 10% or more.
Yeah.
We would not be surprised to see that at any time. We were saying that just prior to the election, as you had, things had come down a little bit, but still very, very strong overall since the end of March. So we would say that's always a possibility, but just what we would consider a correction tends to be fairly short-lived. It's just kind of reshift and rebalancing. There's always a reason. So whether it would have been disappointment from election or disappointment from COVID or whatever, it could have been something we're not talking about right now. Something causes it, but a correction tends to be short enough that other than, when stocks had gone up, we trimmed some things. We've trimmed FedEx and we've trimmed some things that really run. We still want to hold on to them, but we just take a little bit of that profit off the table. We don't want to get, too conservative and say, there's going to be a correction. We better take a lot off because guess what we would have missed this week. So that's where, there isn't a crystal ball to say, if you knew exactly when it was going to happen, then sure. If I'm 100% sure, I'll take some off, save that. But because stuff like this can still happen, we want to be smart about it. We want to trim around the edges, look at if something really looks overvalued, that's where we want to be, pulling back and trimming.
I was just curious as to what your thoughts on.
Yeah, so we would say, it comes down so much to the fundamentals of each company when we're buying individual stocks and then looking at, just the dynamics of the overall market, when we're looking at the ETFs and, watching the valuation, watching what's going on, but there's definitely something to be said for momentum and, the psychology of all of it. So I think we're in a phase right now that we're likely to see some of this positive momentum continue for a little bit. So then there's one more page here for the portfolio summary on page 23. And this is just the summary of the fixed income. So these are summarizing the individual bonds. And as I said, these bonds don't grow. They're like CDs. They're a fixed amount. They pay a fixed interest rate, and they're very stable. We know that on the maturity date, we're going to get exactly the amount that's on the face value of the bond. So as we invest in bonds for you, we can control the maturity of those bonds. So on the left, what you're seeing is just the distribution by maturity. You can see it's a very steady, what we call ladder of bonds, meaning that periodically, every so often, there's a bond that's going to mature. As the bond matures, that can help from a liquidity standpoint if cash is needed, as payments are made. But then what we do is we reevaluate when that cash comes in to say, where do we want to reinvest in a new bond and find the best opportunity at that time. But having the staggered maturities is a really nice way to help deal with fluctuating interest rates, because interest rates can go up and down and that can change prices of bonds, but that also, affects the yield that we're going to get for the next, 3 to 5 years. So having them come in gradually really helps adapt to changes in interest rates and smooths out that part of the portfolio return. Then on the right-hand side is just a similar distribution, but by the quality of the bond. Here, there's all sorts of kind of subcategories, but the point is that these are all investment-grade bonds. They are very high quality. So what that means is we don't need to be worried when the maturity date's coming up, are they going to be able to pay that back? We know that they will. So it's just kind of showing you how that overall breakdown is. So very high quality individual bonds. So that's the portfolio summary. We do like to put together a handful of kind of economic market outlook slides. Unfortunately, these days, these kind of pages get outdated very quickly because things change. So I can very quickly run through what we have here if it's of interest to you. The first page is the CARES Act, just a summary of that first stimulus package passed by Congress that was $2 trillion, roughly 10% of our entire GDP for the year. That was huge. Substantial amount of aid that went out. It was critical for so many individuals, for so many organizations, companies, as well as nonprofit organizations. There's been a lot of debate about another package, and we've not seen anything else come out yet. And so we're watching and waiting for that, but this was significant. Page 26 is just a tidbit on elections and what different things mean, and this looks at over history, depending on what combination you had in the presidency, the Senate, and Congress, what did the market tend to do over that time? Generally, in a nutshell, the market tends to do better when there's some form of gridlock, whether it's Democrats on one side in the Congress or Republican president or vice versa. It looks like we've gotten that this time. It's not 100% certain yet, but that is generally what the market does like, much more than worrying about which party is where. So that I think is important. The rest of the pages here are we do this quarterly, but kind of updating on where we are with the fundamental economic data. So 27 is looking at the unemployment rate. You saw the incredible spike when things shut down earlier this year. That has been coming down. We just got another jobs report on Friday that was even better than expected. So things are continuing to improve so far. So that's very important. The next page looks at just a summary of retail sales. And this is a key driver of our economy is consumer spending. It's pretty amazing here that after the big drop that we saw, you can see the huge negative there, they actually came fully back to where we were before the shutdown. That actually happened much more quickly than folks would have thought. Supported, of course, by some of the stimulus dollars. Page 29 looks at housing. Housing and construction and all those things that go with that are also a significant part of our economy. That part of the economy is doing really well right now. It has not seen we thought at first that it might be an area to be really hard hit as people are afraid to go in other people's homes or whatever, but that seems to have not been a problem, and so we've seen the housing market recover fully and is very strong as well. Page 30 is just that ISM report that we track. That's ISM stands for Institute of Supply Management, and it's a survey-based indicator with one line. The blue one is for the manufacturing sector, and the green is non-manufacturing or just the service sector. And basically, when this is above 50, which is that horizontal blue line, it means that activity in those companies is expanding. When it's below 50, it's contracting. And it's a very accurate indicator of when we are in recession or oftentimes heading to recession. Because this one was we call it kind of a self-imposed recession, as it was a forced shutdown. We did not have that prediction of it, but you can see as soon as it hit, we did see that. Both of those indicators did drop well below 50, but we are now back well above 50. So again, a very positive turn of events for companies overall. It all does, of course, depend a lot on what happens with the virus. So page 31 was just looking kind of through September where we were with numbers. We know these are constantly changing. It does make a difference. I'd say the virus is one indicator, but I'd say from a market perspective, what the market is focused on even more is what is the economic response to that. Do we see another round of forced shutting down? What happens as we go into the winter with restaurants in particular? Restaurants are an important part of the economy, and that is probably one of the areas that's gotten hit the hardest. So we don't want to negate that. So, but there are areas that are hurting and that are weaker. but, you know, acknowledging also these other areas that are actually holding up very well, that when we step back from a broad perspective, you know, we're getting through this okay from an economic standpoint. And I will conclude with the next page, page 32. It kind of all comes back to, you know, we're here talking about investing. So it all comes back really to when we invest in stocks or in a fund that is made up of stocks, we are buying parts of companies. And when we buy a company or part of a company, the question is, you know, we own their earnings, and their earnings are, you know, they're selling something, they're making something or providing a service that they're earning money for, they've got to pay their costs, and the profit is the net result. If that profit is growing, that's what we're focused on, and we want to find those companies that are able to continue growing their profit. This is just a high-level view for the S&P 500 as a total. What is the expectation for their earnings? You can see the dramatic decline that we saw during the shutdown, but how that has been turning back into a positive direction. And it's that trajectory that's important, and to see that continue to increase, that is the key for investing in stocks, is for those earnings to continue to grow. So regardless of political party that's in control, regardless of even the coronavirus itself, what's going to matter for stock investing is what happens to the companies that we're investing in, and are they able to continue making a profit and increasing that. And that will determine ultimately how the stocks do. So just to bring it all back to, that's what we focus on. That's our job for you, is to keep the right balance and within those elements of the portfolio to make sure they're all doing their job.
Thank you, Pam.
You're welcome.
Anyone have any questions?
And I can email this. I probably should have done that ahead of time. We haven't been in that regular routine, but
Yeah, if you'll email it to me, then I
yeah,
can
with
send
folks
it to
that are
them.
on the phone.
Okay, that sounds good. Anyone have any questions? Do we have a motion to adjourn?
I'll make the motion.
Darryl, you want to second that?
Second.
Okay. Well, thank you all very much. This concludes the pension committee meeting. Rick, did you have a question?
No, I just submit the motion.
Oh, okay. Thank you. Thank you all for joining us. And I will email her presentation to those that were on the phone.